You've heard it before, the classic, balanced, sleep well at night portfolio. Global stocks, U.S. stocks, and bonds. It's simple, familiar, and designed to keep you invested when markets get uncomfortable. International exposure comes from VGTSX, U.S. market exposure from VTI, and bonds from BND. The logic is straightforward. Own a little bit of everything, rebalance once a year, and let compounding do its thing. In the backtest we're looking at, this approach delivered about 9% annualized returns. Not flashy, but steady, reliable, and emotionally manageable for a lot of people. But what if you're willing to take more risk? Not reckless risk, not stock picking, but a more opinionated, growth-focused version of passive investing. Still rules-based, still simple, just more concentrated. That's where Portfolio 2 comes in. Portfolio 2 also uses only 3 ETFs, but the philosophy shifts. 60% goes into QQQ, which tracks the NASDAQ 100 and leans heavily toward large U.S. technology and innovation companies. That's the growth engine. 20% goes into XLE, the energy sector ETF, which can benefit during inflationary periods or when energy prices rise. And the final 20% goes into GLD, which gives exposure to gold and often behaves differently during stress or uncertainty. So let's look at what happened in this backtest. Portfolio 1 returned about 9% per year. Portfolio 2 came in closer to 20% annualized. That's not a small gap. And anytime you see a simple portfolio showing 20% annualized returns, the right reaction isn't excitement, it's curiosity. Backtests are stories about the past, not guarantees about the future. Now, let's talk about risk, because returns alone don't tell the full story. Portfolio 1 had a standard deviation of about 10.95%. Think of that as how bumpy the ride feels from year to year. Portfolio 2 was bumpier, with a standard deviation around 14.82%, more movement up and down. That part makes sense. Here's where it gets interesting. Portfolio 1's maximum drawdown, meaning its worst peak-to-trough drop, was about minus 21.97%. Portfolio 2's worst drop was smaller, around minus 17.67%. In this specific period, the more aggressive portfolio fell less at its worst moment. That doesn't mean it's safer. It means the particular mix of assets happened to avoid the biggest pain points of that time. The risk-adjusted numbers tell a similar story. Portfolio 1 had a Sharpe ratio of 0.63. Portfolio 2 came in at 1.16. When you focus only on downside volatility using the Sortino ratio, Portfolio 1 scored a 0.96, while Portfolio 2 was at a 1.96. In this backtest, Portfolio 2 didn't just make more money, it made more money per unit of risk taken. So how is that possible? It comes down to how these assets behaved together during the tested period. QQQ benefited from strong tech performance. XLE had moments where energy prices and inflation helped it hold up, and GLD provided ballast during stress. The portfolio didn't avoid risk, it avoided the specific risks that dominated that window of history. But this is the part you can't ignore. Portfolio 2 is heavily dependent on U.S. technology stocks. 60% is a big bet. If tech enters a long, weak stretch, measured in years, not months, this portfolio can struggle badly. Energy and gold can help, but they won't always save you. This strategy demands patience, conviction, and the ability to sit through periods where nothing seems to work. So, here's the bottom line. Portfolio 1 is built to reduce regret and keep things smooth. Portfolio 2 is built to maximize upside if your bet on growth pays off. One lowers the risk of being wrong, the other increases the reward if you're right. The right choice depends on your risk tolerance, your time horizon, and most importantly, which portfolio you could actually stick with when performance disappoints. This is for education only, not financial advice.